Hello and welcome everyone to the Capital Mind podcast. If you'd like to know more about us, visit capitalmind.in, and if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capital Mind may maintain positions in the securities discussed in this podcast.
Hi everyone, and welcome to a new episode of the Capital Mind podcast. In today's episode, we discuss money, or more specifically, how the amount of money in the economy changes and what that means. We start with simple examples of a central bank creating money, it changing how much it prints, and how that affects inflation and behavior. We move on to the role of banks, commercial banks, and how they are responsible for most of the money around today, and what limits and incentives they have on their ability to create money. This includes stuff around interest rates, reserve ratios, and so on. We then move on to talk about the stock market and PE ratios. And then finally, we talk about the wealth effect and how deferring taxes or a higher house value can impact your spending. We also talk about the highest points of leverage and the best investment that you can make in an inflationary world. So do listen in. Hi Deepak. So the understanding has always been that central banks, or the RBI if you want a specific case, are the ones that create money. And if they create too much money, then that sort of creates inflation because there's too much money chasing too few things and so on. But that understanding doesn't seem to be panning out and working anymore. And as we look at the state of the economy, I think America is a more acute example, but even in India to some extent, that relationship doesn't seem to be the one that's determining money supply or how much money there is anymore. So could you let's help us dive into this? How is money created? How does it grow? And how does all this work out?
Hey, Shrey, this is a very interesting question because, this is like the basics of, economics or, the way things are. And because I want to go from the core parts of the economy. Why was there money at all ever? So because if a person had a cow, you could buy a cow from that person and you gave them 3 goats. But then your issue is, what do I do if I want to buy, a table? You can't give half a goat. It's not possible. So it's a little more complicated to start working with goats as a unit of I have this, but what do I do with it? So people said, okay, let's have something common that we could denominate what we own in, so that, and there were 2 desirable aspects to it. Lots of desirable aspects to it, but the 2 of the desirable aspects concept is if you have this third party thing, it's what is called fungible and it's divisible. And the fungibility concept is I can use my goats, if you may, to buy a cow, but I can't use my goats to buy something like a grain or a bag of rice. So you wanted something that could be used to buy anything, and that anything is what makes money fungible across a number of things. And then you have divisibility. So I could buy something for 100 something X, and then I could divide it. That person who gets this 100 can divide it and buy something for 2 of that currency. That what it is just money. And that is how money started becoming popular. Initially, maybe people started doing it with gold, and then gold had this problem of saying, listen, give me 10 grams of gold for X, and then I could do 8 grams. So it was divisible, but it was complicated to divide, and then there was impurities, all sorts of other things. So this is how the money concept came about. But now you have a complexity around money, banking and system. Now let's say that, once you have money, somebody has to print this money, somebody has to give it to everybody and so on. Let's take this example of an island. And that island is, it's an independent island of its own. There's only one bank. Let's call it the central bank because it's just how it is. Now you have 1,000 people on that island, and there's a one bank. That bank is providing all the money to the people. They've decided they want money. Now these 1,000 people roughly produce 10 things each. That 10 things, each of those things costs say 1 rupee. So there's 10,000 widgets in this island. Each of the widgets costs 1 rupee. So how much money do you need to buy all the widgets? Of course, you need 10,000 rupees. So therefore, you need to have printed 10,000 rupees that made available to people to buy or sell those things. So now let's say the central bank prints 10,000 rupees, gives every of those 1,000 people 10 rupees and says, you can go buy whatever you guys want. Everybody then uses it. And then because they have this new money thing and all that stuff, some people will have more, some people will have less because of whatever. But some people are more enterprising. And suddenly people start getting more productive. And instead of producing 10 things, they start producing 15 things.
Widgets each.
Widgets. Yeah. I mean, some people may be producing more, some people may be producing this, but the average has become 15 widgets per person. But there are 15,000 widgets. There's only 10,000 rupees available in the system. Technically, if you actually wanted to buy stuff, it should fall in price, right? Those widgets should fall in price because there's not enough money available for all of those things to actually go into. I'm giving a super broken down example.
No, but this works. So there's still only 10,000 rupees in this island, and there's now 15,000 widgets. So that's like everything would kind of have to fall to 67 paisa or something like
Correct,
that, right?
67 paisa. So the problem with this is, now let me go back to what this has happened. We've taken something that's 10,000 widgets and made it 15,000 widgets. You've actually had a productivity growth of 50% in a way. But let me come back to what that means. It's called real economic growth. Now, you've got real economic growth in terms of productivity, but there's only 10,000 rupees of money supply. So you can, if you're a person who is on the spending side of things, instead of buying that one widget which was useful for you you started off buying it at 1 rupee. The next year, its price is 67 paisa because of, whatever has just happened. Now you're saying, dude, it's fallen from 1 rupee to 67 paisa. Tomorrow it'll fall to 50 paisa. Why should I not just save my money, keep it with me instead of spending it today? Because if I spend it today, I'm going to go deflationary and the same money is going to buy more things tomorrow. Now, typically in inflation, people spend today because tomorrow that thing is going to get more expensive.
On this deflation point, is there an expectations thing where people kind of assume that there will be more productivity and that's why deflation will happen?
People don't actually assume it to have happened, but it's complex in the sense that deflationary expectations create a spiral that reduce overall spending. Now, the spending that people do in general is more like, if I don't buy this today, it's going to either get more expensive or I'm not going to be able to use it, or, I need it really desperately right now. So what's going to happen if prices start coming down or wages start coming down or prices start coming down is that people will say, let me reduce the amount of money I spend to the absolute basics, and then any discretionary level of spends I will do later at a later point. So you have a problem because if people don't spend, the economic growth doesn't happen. If the economic growth doesn't happen, you can stall, you can create all sorts of problems. And then you can't do something very clinical which the economy has, which is if you propose to pay a salary to a person of 20 rupees, you can't go and tell him, listen, just because the stuff you're buying has become cheaper, I'm going to reduce your salary to 15 rupees a month. So people don't like getting lower salaries, even though their spending has come down, right? So because of this, you have an issue with the economy where some prices cannot go down because they're sticky and they're called wages and all that stuff, and some prices can. So what do? When deflationary situations happen, the companies which have expensive employees go out of business. So it becomes a destructive loop at deflation. And then new companies come in which are hiring employees at 15. So people, instead of taking a pay cut, get fired at $20, or the company goes out of business at 20 rupees per month, and then they get new jobs at 15 rupees per month. It's the same thing, except it's gone through a very destructive, mentally taxing thought process of one company had to shut and a new company had to be created, and there can be timelines when these things are not exactly one after the other, and that could be the problem. Now, what would a central bank do? They say, we can't have all this shit come down to us. You can't have deflationary situation. So let me at least do this. I'll print another 5,000 rupees. I give it away. That 5,000 rupees that comes into the economy will then ensure that all the prices still remain 1 rupee each. That is great, because if you're printed 5,000 more rupees, then everything is worth 1 rupee exactly the same. So you've got a price increase. To give you an example of how what this means, it means that to the level of productivity benefit, which is real economic growth, you've got no differentiation on prices. Inflation will remain exactly the same. What if I told you that the central bank decided, dude, forget this. Let me print 20,000 more rupees. So instead of, I first printed 10, then got a productivity benefit of 5,000. I will add another 20,000 rupees into the system. That means I have 30,000 rupees in the system now, but only 15,000 widgets. Technically, over time, the prices, if people are not saving their money, if the people are just spending their money for whatever they get, they will make the prices go up to the point where it is 2 rupees per unit. Right? So 2 rupees per widget. So prices have gone up from 1 rupee to 2 rupee a widget. Productivity has gone up from 10,000 widgets to 15,000 widgets. You have nominal economic growth of 200%, which is 10,000 became 30,000. But money supply grew by 200%, right? So if think of it as if all those 2,000 extra was in 20,000 extra was, or the whole 30,000, because everybody's spending all of their money. The whole 30,000 rupees reflected in GDP. You got nominal GDP of 30,000 and real GDP of 15,000 in a way. So the economic growth, real economic growth was 50%, but nominal economic growth was 200%. So there is a differential in terms of what has just happened. The central bank has printed more money. It has come into the economy, and that coming into the economy has resulted in 15,000 rupees more money than the productivity benefit could have added. But let me put this in a much clearer form. Okay, so India has roughly 6% real economic growth. That's what we've been talking about. Our economy is roughly 240, maybe 240 or 2.5 trillion, 3 trillion nearly. So 230 lakh crores. 1 lakh crores, 1 trillion. So I can use that as a number. There's 240 trillion rupees in Indian GDP. So 6% of that, that's about 14 lakh crores. The central bank has to print 14 lakh crores just to stay in close with productivity every year. It prints a lot more than that. It prints about 20 something percent. So that extra amount is accounted for inflation. In inflation, so it prints about maybe 26 lakh crores a year. That's the amount the money supply goes by. But here's the interesting part. It's not the central bank. And that is where I'll talk about it in a different way. So you've got money printed, but it's not the same as the money spent. We said the village got 10,000, the central bank printed 5,000 more, but it's possible that even though the central bank prints a little more money, total amount of money printed by RBI till now from all things put together is about 63 lakh crores. That's the total size of the RBI balance sheet. The total amount of money in Indian banks is about 200 lakh crores. So there is a multiplier here. So who actually created this money? It wasn't the central bank. It was something else. And we'll talk about something else. Here's where we should look a little bit more at what happens in a banking system. In a banking system, let me start from this. Maybe we should go back into this phenomenon. You look at a currency note that you have. You look at a 100 rupee note, a 500 rupee note, a 200 rupee note. They all say, I promise to pay the bearer a sum of 200 rupees or 500 rupees or 100 rupees. And you're looking, dude, isn't this 100 rupees? Why are you telling me you're going to pay me another 100 rupees? How does that be? But then you look at the 1 rupee note. The 1 rupee note does not have anything of this sort. The 1 rupee note has no saying at all. It just says, the issued by the government of India rupees 1. That is a rupee. That is the only rupee this country has. Of course, all coins are also rupees. That means printed by the government of India. But this is the only currency that India has. Everything else is a promissory note from the RBI. So what is issued by the government of India is the 1 rupee note and all coins. What is issued by the RBI are promissory notes to you and me that says if we want, the RBI needs to give us at some point in life 100 1 rupee notes for every 100 rupee note you have, effectively. I mean, that's what the RBI is effectively telling you, right? So for you, that rupee note is an asset. You trust the RBI. For the RBI, your rupee note is its liability. So it owes you this whatever rupee it is. You are a direct customer of the RBI, except the RBI doesn't ever talk to you or meaningfully interacts with you more for the most of the time. But you are actually a customer of the RBI. Now, this is the only time when you are such. There's, of course, the new concept of CBDC, and in the CBDC, you are a direct customer of the RBI because they've converted this currency note into a digital format. However, this actually means that this is the only time you're directly connecting with the RBI. Otherwise, your bank accounts are with banks, with public sector banks, private sector banks, whatever they are. You actually have something else. Now, why is that? Because RBI has actually created intermediaries. They said, we don't want to talk to everybody, boss. This directly giving money to people and all is crazy. Let's create a buffer area. Now, this buffer area is essentially banks. Banks need to be taking risks. Now, RBI cannot because it's a central bank and all that stuff. Banks need to be taking risks to lend and borrow. You will deposit your money with the bank, you will take a loan from the bank, and then you will give a bank money. A central bank essentially says, listen, you guys do your thing. If you guys fall short of money for whatever reason, let's say you've lent out 100 rupees and somebody else wants his deposited 100 rupees with you, says, I want my money back right now. I want 50 rupees. And you're like, dude, I can't go to that guy and say, who I lent money and say, give me back 50 rupees because this guy wants it. So I will borrow from the RBI 50 rupees and eventually I'll find another depositor or something like that who will take care of that stuff. So the lender of last resort is RBI. Now, let's say there's a bank called the State Bank of India. It's not the RBI, it's the SBI, right? So it was again the only bank in town. RBI is separate. RBI has done its own thing. Technically, let's say you're Shrey and I'm Deepak. We are all customers of SBI. You give SBI 5,000 rupees and I go and take a loan of 5,000 rupees. Now, because I don't take it in currency notes, I leave the money in my account. I may have a loan of 5,000 rupees, leave that separately, but I am thinking the amount of wealth I have right now is 5,000 rupees sitting in my bank account. You think that you have 5,000 rupees sitting in the SBI bank account. How is it possible that it was only 5,000 rupees earlier and suddenly now there is 10,000 rupees in deposits and 5,000 rupees in loans, right? So you don't net off the loans right now, but I'm just saying that if the entire amount of money that RBI printed was only 5,000 rupees and gave it to SBI, let's just say, then the total amount of deposits in the economy can actually be much higher than that 5,000. It's just that the 5,000 was a starting point and it's a multiplier. So RBI in total, like I said, has printed 63 lakh crores in total. But the total economy, the more money in the total economy, if you add all the deposits of every single entity put together, that's about 200 lakh crores. So this is so much money beyond what RBI has ever printed. And that's because the money that is being created is not being created by RBI itself. RBI doesn't, when it prints money, it doesn't create money for the economy. What happens is when SBI gives a loan, that money comes back to it as a deposit, and that is what creates money. And you can do this endlessly, right? So for instance, it can take 100 rupees from Shrey, lend it to Deepak. Deepak gets 100 rupees, puts it in his bank account. Now there's 200 rupees in deposits. Then that money can again be lent to, say, Vashisht, and now there's 300 rupees in deposits. That money can again be lent to somebody else. It can keep on going forever, and you might think, dude, there must be a way to stop this. They can't be here forever. What nonsense is this? They're just adding. Everybody's just getting money out of free air. Money is created out of free air, and the only thing that's stopping it is something called a capital adequacy ratio. Remember I said, banks need to take risks. RBI, that's what they said. Bank says, listen, your depositor, Shrey, cannot be told that you can't go to Shrey and say, sorry, dude, Deepak didn't pay back his money because he decided to default. So your 100 rupees is also gone. RBI is like, dude, you can't do that. That's not a confidence generating system. So they say, listen, if Deepak defaults, you, Mr. SBI, are at going to take the risk. So you should have a capital of your own that protects you from defaults. Now, this capital adequacy ratio means that for every 100 rupees of loans that you've given out, you need to have 15 rupees, 15% capital adequacy ratio. This is a simple concept called a capital adequacy ratio, which means that forget 15%. Let's say there's a 10% CR, just to take that risk, the concept away. So what that means is if I will lend 100, I will get back 100 as deposits. But of that 100 I get it as deposit, I cannot lend another 100. I can lend only 90 because 10% I have to keep. I mean, because let's say it's my 100. I have 100 rupees. I lend it out. I get it back as a deposit. Because the minute I get it back as a deposit, that deposit I have to keep 10% of it aside. It's called the capital adequacy ratios, of course, on lending. It's not on deposits, but roughly the same thing. The concept is that when I lend 100 rupees, I have to take 10 rupees out of my capital and say I shouldn't lend more than that. So I get the 90 rupees back. Then I can lend when I lend out another 90. I have to keep 9 rupees of my capital as buffer. So that means I have got 19 out. If I keep doing this over and over again, out of the 100 I have, I can go up to 1,000 rupees of lending. Remember, as a bank, I can create money out of thin air. I can go to any number I wanted. But I have to stop at 1,000 because RBI says, listen, your CR hits 10%, please stop. Now, you do have a problem that there could be a lot different depositors and a lot different borrowers. Because the borrowers will borrow money, but they'll spend it. So let us say, Shrey, you're like the best, most well-financed person in town. Everybody who takes a loan somehow buys things from you. So it's possible that there's a system in which you have deposits of 900 rupees. In a system where I have say SBI as a bank has only 100 rupees in capital, it has magnified that to 1,000 rupees. Like I said, it's borrowed, lent and all that stuff. It's given money to different people, but somehow most of that money has come to you. Now Shrey has on the depositor side 900 rupees, 100 rupees with other people. The remaining money, the remaining loans and all that stuff is with a bunch of other people who have used the money to buy a house. Now I go to you and Shrey decides, listen, all this is very nice. The bank, SBI, has 100 rupees of its own capital. But I need 200 rupees of my money back. I have 900 rupees in the bank. I need 200 rupees back. Even if the bank were able to somehow produce 100 rupees of its own capital back, it still is short because the remaining 100 rupees that you've demanded is just simply not there. It's a bank run. Effectively, a big set of depositors have made a run on the bank. Then the bank will go to RBI and say, please help me. RBI will say, fine, how much do you need? It's I need 100 rupees. They'll say, okay, take 100 rupees from us for temporary purposes, go pay Shrey. This is a bank run, but RBI is helping in this case. In India, if any time more than 10% of the money in deposits is withdrawn, the bank is screwed.
This seems like an extremely high number, right? I mean, surely this never happens. I mean,
Silicon Valley Bank in March of 2023, we are talking 43% of the deposits were withdrawn on one day.
Okay, so just coming back to the first thing, it's because after you take your money out, you keep it under your mattress? I mean, you just move it to another bank, right?
So when you think of the banking system, it's like any bank is effectively a part of the banking system. And then as long as you're not taking out in currencies is a leakage from the banking system. So when you take it out as currency, it goes out of the monetary system in a way. So if people were to deal with each other only in cash, they would not need the banks. There would be no leverage at all. Because once I give you a 100 rupee note, all you can lend is that 100 rupee note, right? But in banks, if you give banks 100 rupees, they can multiply it by 10 times and lend 1,000 rupees as long as they have enough capital. This is a fractional reserve system, which means for every rupee I lend, I need only a fraction of it in my own capital. People like FTX, unfortunately, in the crypto ecosystem, did this unbelievably spectacularly in the crypto world, which means that they told you had that they had about 1,000 Bitcoin and they actually had only 100, and they were fine with it for a while until somebody pulled their money out and said, give me back my 1,000 Bitcoin or forget that, give me back my 50 Bitcoin, 100 Bitcoin. So enough people just saying that was enough to wipe out the entire system because they simply did not have the reserves. And in Bitcoin, there's no central bank at all because they don't believe in central anything. So the idea was central death, which is basically the death of whatever it is called a decentralized concept for a reason. There's no central authority of any sort. So a guy who's like an exchange like FTX, which tried to create a model which was a trading exchange, tried to do fractional reserve banking in this, got screwed completely. Now think of it one level away. There's a bank run. I was a banker on SVB. What did SVB do, or what happened to SVB effectively was that SVB had a very large amount of money. It was not like it was undercapitalized. But let us say it had bought securities at 100 rupees worth at some point in time. Those securities were today worth 40 because the interest rates have gone up, etc., etc. They're only worth 40 rupees. If they hold it to maturity, which could be 5 years, 10 years down the line, they will get 100 rupees back. That's because it's the government security. So they held government securities whose current value is only 40 rupees. The idea is if you're a depositor and you also held for the next 10 years, you would get back all your money no matter what. It's just confidence. But because you ask for your money today, the maximum I can pay you is a 40. And the more you ask me, the more government securities I have to sell. The more government securities I have to sell, the more likely it is that the government security prices fall even more. So what was 40 becomes 35 and becomes 30 and so on. So this was a traditional bank run with a bank that held ultra safe securities as well, simply because the fractional reserve system just works that way. Now, I would say let's step back a little bit perhaps and say, who created this money? At one level, RBI prints money. At another level, the banks get to print money. In fact, the biggest thing is when the banks get to print money. Banks, because they print money, can effectively write their own balance sheet. Now, think of another concept. Why is there an RBI and why are there banks? RBI does not deal with us directly. RBI has, therefore, an account for every single bank. So how does it print money for a bank at lender of last resort? It says, listen, you guys lend, and then whatever else is there, we'll deal with it, and I'll give you money in case you're in dire necessity. So this point is that RBI has a bank account for every bank. So it does not have a bank account for you. You don't have a bank account with RBI, but every bank has a bank account with RBI, and one other entity does, which is the government. The government has an account with the RBI. The RBI is the merchant banker for the government. The RBI has it, this thing. So RBI prints money. Some part of it is for productivity and some part of it is effectively inflationary. It needs to print, like I said, 14 crores a year, 14 lakh crores a year, just so that prices don't crash in a way. That 14 lakh crores may not be entirely printed by the RBI. It may be printed only partly by the RBI and then comes into the system, gets multiplied, right? So it can print 2 lakh and then get multiplied 7 times by banks. It's possible because remember capital adequacy ratios are say 15%. So every 15 rupees of capital that a bank has, it can leverage it 7 times. So that's roughly 100 rupees. So if banks are lending 100 rupees, then they have only 15 rupees. So every incremental 100 rupees needs 15 rupees in capital. If for whatever reason, RBI was buying equity in banks, printing money and buying equity in banks, then every rupee printed could be multiplied 7 times by the system. So if we need 12 or 14 lakhs crores in the system, RBI needs to only print about 2 lakh crores in order to get that equity. But that's just the way things are. So also, the RBI has a very specific way to do things. It's a central bank, but it also has accounting. It can't just print rupees. I mean, that doesn't make any sense, right? So what it does is for every rupee it prints, and remember I told you that I promise to pay the bearer is the RBI's liability. So all money, all Indian rupees are the liabilities of the RBI. RBI then buys something as an asset because for every liability you should have an asset. So what does it do? It buys bonds, Indian government bonds, and it buys US government bonds, effectively, foreign exchange, from other banks. It can also buy gold. from banks or from other entities and give rupees against that. Now, here's where it's interesting. A total of 63 lakh crores, only 13.7 lakh crores is Indian government securities. 43 lakh crores is non-Indian securities. For the most part, this is US. So assume that every rupee printed in India by the RBI is actually backed more by American. So we are funding the American government more than we are funding the Indian government. That's just by nature of the game. RBI that way is funding the US government more than the Indian government. And it doesn't want to, of course, print too much because it can print too much and cause inflation. Why does printing money not cause inflation anymore? Think about what happens. Banks have a certain amount of capital. Banks are afraid to lend when situations are very dire because they're like, dude, this guy's going to default and then I won't have enough capital remaining. So I will be very, very, circumspect in lending. RBI prints money. How does it print money? It says, okay, I'm going to buy bonds from you, Mr. Bank. Bank says, fine, take my bond, I'll sell it to you and you give me 100 rupees. Then RBI says, okay, fine, we've printed 100 rupees and we've given it to you and we've taken your bonds. RBI says that, but the bank says, thank you for the 100 rupees, but I don't want to lend it because these people who I'm lending it to, the Shreys and Deepaks, we are afraid they will default. So I don't want to give them any money.
So I'll go and buy another bond.
So I might go and buy another government bond, which is technically low risk, which is what happened in the US. The US, the people would just take money and buy bonds as much as they could. And then some point, even that is not good enough. So what I do is I take the money from which I have as capital or which I have as money and give it back to the RBI. RBI just bought a bond from me, so I have money in my thing. Give it back to the RBI and saying, listen, I don't have any use for this money. Can you keep it back with you? Banks, therefore, got money and gave it back to the RBI as reverse repo. Or we'll come to that at a later point. What is where did it go? And that did not increase the money supply in the banking system itself beyond the RBI. RBI printed money, got it back as excess reserves. Banks themselves said, we don't want this money. We're okay. Thank you very much for the money. Thank you for buying this bond off of us. But that bond created a 2 rupee profit for us. That 2 rupees is what I can leverage and lend out. But I will not lend out the 100.
So, in a sense, this is why the RBI doesn't always, or the central bank in this case, isn't necessarily the one causing inflation. But the example that comes to mind is in the US when they actually gave out stimulus checks. That did perhaps cause a bit of inflation. But anyway, coming back to your point, which is that the central bank, the mere printing of money would not be enough. By the central bank is not enough to cause inflation. Banks have to play along, if I may put it that way.
Banks have to have what is called a liquidity deficit. So they should be able to borrow. They should be able to take this money and say, oh, this money is great. Let me go deploy it and get a lot of money. Think of perhaps, why companies, large IT companies in India, for instance, they give such big dividends and big buybacks simply because they have no use for that money. If you give them more money just like that, they'll be like, what do I do with this? I already have enough money on my own.
Give it to shareholders.
I'll give it back to shareholders. So
and they don't have debt, so they can't pay down debt.
Yeah, they can't pay down debt. So there's essentially think of RBI doing the same thing. It's like pushing money into banks and saying, listen, you guys need to go lend. Banks are like, dude, we don't have capital, we won't lend. So it comes back into RBI. Sits in as excess reserves. Now, RBI may buy government bonds from the government. It may also buy dollars. And how does it buy dollars? An FI comes into India and says, listen, I want to invest in this Reliance retail thing, which they want 1 billion for. So here's $1 billion. Give me the rupees that I can invest in Reliance. Banks are like, dude, I don't have $1 billion rupees. So, I don't have $1 billion worth of rupees. So let me go to the RBI and say, RBI, dear RBI, will you please buy my dollars from this customer of mine so that we can, So RBI says, fine, I'll print 8,000 rupees and 8,000 crore rupees and buy $1 billion from you. So the $1 billion goes to the RBI as reserves. The rest, the money that comes into the economy, goes to the bank. The bank takes the money and gives it to the customer who's some fund. That fund goes and gives the money to Reliance, who can then do something with it. In general, RBI is sitting with now $600 billion roughly worth of foreign exchange. Part of it is foreign exchange assets and some of it is gold. And this value fluctuates a lot. And for some,
And I think one of the reasons you had pointed out is some of the fluctuations don't come from just funds flowing in and out, but from the mark to market, and say the rupee gets stronger against euros or non-dollar currencies, and therefore it looks like you have less forex reserves because they're all demarcated in dollars. Redenominated in dollars for that total number.
yes. So for instance, right now what has happened is the dollar has strengthened against the Japanese yen. If the RBI had 100,000 Japanese yen, it was worth $1,000. Maybe a year and a half back. If it continues to hold that same 100,000 yen today, and the yen to dollar ratio is about 150 to 1, so it now has only $6,660. So $666 compared to what was $1,000 a year back. So technically, the value of the foreign exchange in dollars has fluctuated simply because yen has kind of depreciated. So in the sense, this excess reserves now. The way to think about it is, and somebody, I think it was one famous economist explained to this, I think it was Ajay Shah at one of the things. Think of a big wall, and maybe I should call this a dome, a nuclear dome, okay? It's encased with lead. Inside is the RBI and outside is the rest of the world. The RBI doesn't talk to the rest of the world. The RBI has little windows in this massive structure and it talks only to banks. Each window is a bank. Banks have accounts with the RBI. Banks also have accounts of human beings like us, people. So its assets are the amount it has stored with the RBI. Its assets are also the loans it has given us. Its liabilities are the deposits we have given it. So think of it this way. Now, you're not directly interacting with the RBI at all. Money that RBI prints and buys bonds comes to banks. Unless banks actually lend it out, it has not come into the economy. If banks switch back and give the money back to the RBI and say, oh, please take my money back as reverse repo, in the US it's called excess reserves. If you take your money back, take the money and give it back to the RBI, that money is staying inside the nuclear dome. There's nothing coming outside the nuclear dome. So whatever is not coming outside the nuclear dome is not inflation. It's not going to be inflationary. It's only inflationary if the people outside are in that say. So for instance, in 2007, there was a huge inflow of forex into India. The rupee fell to 38 rupees after being at 45 or 50 rupees and all that stuff. It had fallen to 36 or 38 rupees per dollar. And the RBI was buying so many dollars that any dollar that it could find it to buy. And because of this, what happened was, and banks were also able to lend because the banks' credit growth was more than 30% per year. In fact, it was so big at that time that literally anybody who wanted a loan, banks were giving it. People wanted it. It was crazy. We were really small as a banking economy at that time, and banking growth was intense. If it happened at that level, it was also because banks were getting equity capital. That's where the dollars were coming in. Banks were saying, let's raise some money. Some foreign investor would say, fine, take $1 billion. You take $1 billion, it goes to the bank's capital. Banks can multiply that $1 billion by 6 times. So it was 6 billion rupees worth of 6 into whatever. So it is about 50,000 crores. 1 billion is about 8,000 crores. So about 50,000 crores worth of lending would be supported by 8,000 crores worth of borrowing. Now this is interesting. This is what Bajaj Finance has just done. Bajaj Finance has just raised 8,000 crores as QIP equity capital. QIP, a lot of that QIP has come from abroad. So effectively, foreign customers will give Indian banks or Indian NBFC some money, and that money will get multiplied by 6 or 7 times. And if you say 6 times, it's about 48,000 crores. That's now Bajaj Finance itself has only about 200,000 crores of lending right now. If the additional 8,000 crore comes with a 15% CR, it can do 6x, right? So if it gets 8,000 crores in capital, it can lend another 50,000 crores to customers. That 50,000 crores is enough for Bajaj Finance to grow 25%, because it has 200, it will become 250. So it's 25% growth that Bajaj Finance is doing. So who's creating the money? Effectively, Bajaj Finance is creating the money, or HDFC Bank is creating the money. These are not RBI. The RBI didn't print this 8,000 crores. Of course, it may have printed it in order to buy the dollars to augment its dollar reserves. But effectively, the RBI would have been responsible for a very relatively small amount of it. This is, I think, the number 2 part of creating money. So you created money from the RBI printing money. That's a smaller portion. The larger one was banks lending and creating money. That was a much larger portion. Banks getting more capital by diluting themselves and then doing QIPs, raising money. We also see another form. So creating money, and because we're talking about how money is created, inflationary impacts come from when the money supply grows from the banking system and the NBFC system. It results in an increase in money supply that is even greater than the productivity growth. So if you grow at 18% a year, but real growth is only 6% a year, that extra 11-12% will eventually contribute to inflation. Not now, but it's just maybe further down the line. There's just more money available, and as long as more money is available and being spent, there's a concept called velocity of money. If the RBI prints 1 rupee, how many times does it pass through the economic order? So it could be that you get some money, you pay somebody, that somebody pays me, and then I pay you. So it's the same money that's being transferred across multiple. The velocity of money is, the higher the velocity is in this context, you will end up with a different multiplier effect to every part of this money printing ecosystem. So if RBI prints, how much does it result in velocity of money going forward, and so on. Now, there is also temporary money. Now, I told you that the government has an account with the RBI. That means the government's account is inside this walled dome, right? So inside the nuclear dome. When you and I pay taxes, they go to a bank account, which is eventually the bank account of the government is the RBI. So it's money going back inside the dome. Money outside the dome is money. Money inside the dome is not money. Therefore, money supply shrinks. Banks may find it difficult to raise capital, because if you're doing an NEFT, they have to have that much cash available to be able to do that NEFT and so on. They may not have that capital now available. So what they do is they go to RBI and say, listen, we want to borrow from you temporarily, 1 or 2 days, maybe 15 days. I'm happy to give you collateral. Now, what is this collateral? For every deposit that you're making, 80% of that deposit will have to be used to buy government bonds. It's a compulsory requirement. Which means a bank can take your money as a deposit, but it cannot lend out all of it. First, it has to put 18% with the government, with the RBI. It can use this 18% to say, dear RBI, I need some money urgently. Can you just take this 18% or whatever I have, this thing, and just give me some money against that, the overnight or 2 nights, something like that. This is short-term money that is created by the RBI, which is called short-term currency infusion or something like that. It's basically short-term money injected by the RBI into the economy. Usually this is positive because banks borrow from the RBI. Last 5 years, since demonetization roughly, we've had banks net lending to the RBI. That means RBI has printed a truckload of money, banks can't use it, they're just having extra reserves back with the RBI. And that has the complication now. So banks have something called, this is the 18% government, it's called SLR, statutory liquidity ratio, which means we'll protect you against a bank run to that effect. That means you have an 18% bank run. You effectively get protected, right? But it was also created for another reason, because the government itself wanted to borrow and it wanted to ensure that there was somebody who's,
But is that still required?
Interesting that you say that, because honestly, the government is printing a truckload of money. So, requiring a truckload of money. So they have spent 35 or 40 lakh crores in a year. They make only 22 to 23. The remaining 17, 18 has to be printed. The 17, 18, when it gets printed, has to come out of pockets of banks who will buy these bonds from the government, and then they will give the government some money. So, but also that every deposit in a bank, 100 rupees cannot be lent if you deposit 100 rupees. You have to have 18% SLR. So a bank will park 18% of it in government securities. Then there's 4.5% CRR, cash reserve ratio. RBI says, I don't care for your bank run business. I think 3-4% should be in cash. You cannot lend it out. You have to keep it with the RBI at all possible times. That means 22.5% now is gone. It's 18% SLR, where you're only 7%. You're only lending 78 rupees odd, because 22% is gone, right? Now, this is, you can understand why the deposit rates in India are much lower than the lending rates. So if I deposit for 100 rupees at 6%, the lender can't lend at 6% to be break even. To be break even, the lender will have to say, oh, you know what, 18% of this money I have to put in government securities. I will get a yield of only 6% on that. 4% of the money is at CRR with RBI. I get 0% return on that. The remaining money, if I want to lend it out to people, I can't get a blended rate of just 6.5%. I have expenses, I have other things. I need to lend at 9%. And that 9% can be 9% blended average of all the loans I've lent. I've lent to companies doing export sales. I'm doing domestic companies. I'm lending to other institutions for a short term, or I'm lending to individuals to buy homes and other stuff. So all of this means that there is a difference between what a bank lends at and what a bank borrows at, and that difference is effectively called the net interest margin or the spread. So you want to make sure that you make enough of a spread that says, with that spread, I will account for the fact that I'm getting a lower rate because 18% of my money is blocked in SLR, 4% in CRR, and a bunch of this, something called HQLA and liquidity coverage ratio. So won't go into all of that, but the idea being, after all of this, I should have enough spread to pay for my rent, my employees' salaries, my provisions for default. Because if I assume that, let's just give you an example, 100 of us give money to the bank, and the bank is easily making, say, 10% from each of us. Let's just say, so it is 100 will become 110, right? But no, one person defaults. So if one person defaults and everybody's taken a 1 rupee as a loan, that 1 rupee goes to zero. So instead of 100 becoming 110, 100 becomes 109. And therefore the bank has earned only 9 rupees as a profit. Typically this 1% is where your credit costs are, but in some banks it can be as much as 4 or 5%. It can be such a big number that it can dwarf a lot of the other things. But this credit cost is what also you must account for. So you're going to take this distance between the amount of money you've lent versus the amount of money you borrowed. So you lent money at 10%, you borrowed at 6%, the spread is 4%. That 4% should cover for credit costs, employee salaries and rent and operating expenses. And of course, the fact is you don't want to do this business for charity, because you're like, dude, nobody's going to want charity in this business. So let me also put some provision for some profit. So I want to provide for credit defaults. I want to provide for my employee expenses. If my NIM is 4%, I want to earn a profit of at least 2%. So, or 1% or something like that. This is where it becomes important that you've now created a third layer. Now, what is the third layer? This third layer is this NIM itself is a third layer. But think of it another way. If I have deposits of 100 rupees today, nobody prints anything at all anywhere else in the ecosystem, and lend it out at 10% net, my 100 should become 110 by itself. So the money supply should grow by 10 rupees simply because there's interest being charged by players in the ecosystem. So in a way, interest also adds money. So we've said central banks create money in some way. Not so much inflationary, but yes. Banks create money, yes. Banks are the ones that always create money. And apart from banks actually creating money by lending, banks also create money by virtue of charging an interest rate on that lending.
I get that, but when you think about, actually my mind kept drifting towards the stock market. But and the reason I wanted to bring that up is, who creates the money when that happens? I mean, that seems to require no one's consent really, or none of these financial parties involved. If a stock price goes up, the same way the interest is almost like this natural way of creating a drift and increase in the money supply or in the amount of money. Surely a similar thing like that happens every time a stock price goes up as well. Would you agree?
Oh, yes, yes. In fact, this is where it's beautiful, okay, right? So, most zero-sum games are like, gambling. You make money, somebody else lose money, and so therefore that person's loss is your profit. Think of a, a companies whose shares you buy. The share price you may buy the share from somebody at 100 rupees, the share price can go up to 150. And then when you sell it, you make a 50 rupee profit. The person who buys it keeps it and the money share goes to 200 rupees. So who's lost money? Answer is nobody. It's not a zero sum game. It's a multiplying sum. And this is because, and let me come back to the basic. I told you India's total money ever printed, all put together is 200 lakh crores, 200 trillion rupees. The stock market cap of every single company in India, if you add it all up, it's 340 lakh crores. How is there a difference between 200 lakh crores has ever been printed in our lifetimes, but the company's market caps adds up to 350 lakh crores? This excess is because, let me again exemplify. Okay, let's say there's a company, it has 1 lakh shares. It makes 1 crore in profit. That means it's 100 rupees per share that it's making in a profit every year. For whatever reason, you decide that this company should be trading at 20 times earnings. That means if it's earning 100 rupees, it should be trading at 2000 rupees per share, giving it a market cap of 20 crores. That means this company is worth 20 crores if all the shares are sold today. Just saying, but that's not true in all the time. The company continues to be valued at 20 times earnings and makes an incremental profit of 25% more. That means instead of making 1 crore profit, it makes 1.25 crores profit, right? So instead of earning 100 rupees per share, it earns 125 rupees per share. It continues to be valued in the market because people like this kind of company at 20 rupees at 20 times earnings, which means the price which was 2,000 rupees has become 2,500 rupees per share, right? This is, again, a market cap of 25 crores. There's still a 1 lakh shares. So how come the company earned only 25 lakhs more, which is 1 crore to 1 crore 25 lakhs? But the market cap went from 20 to 25 crores, which is 5 crores. There's a multiplier effect here, right? That multiplier effect is effectively what the banking system did with their sort of money. But here there's no concept of fractional system. But just the fact that you're willing to pay 20 times earnings is enough for every profit to be amplified 20 times into what is called stock. The total stock of the market, the stock of market cap in the country has gone up 20x more than the earnings, right? So you've got that multiplier, and that multiplier in the long term is what results in the fact that your stock market's total value is 340 lakh crores, whereas the total money printed is only 200 lakh crores. Not all money has gone into the stock market, a small amount of it is, but that small amount has multiplied itself to 340 lakh crores by itself. The stock of all houses in the country, if you look at the stock of all houses in the US, they're probably worth 2x or 3x GDP. What was GDP is about 20 or 28 trillion dollars, but the housing stock, just the housing stock in the US, if you sell them, if you sell all of them at the current market price, and of course nobody can sell everything at the current market price, there would be no buyer, because if everybody wants to sell, where's the buyer? Therefore the value of everything is zero at that point. But assuming that you can sell everything at the current market price, you're looking at something that's 100, that's something like, it'll be, I think, 2x or 3x GDP. GDP is just the value of all transactions in a year. Stock, which is, I'm talking about flow and stock. Flow is something that's a transactional element of how much you earn a year. Think of a salary as flow and your savings as stock. So your stock is what you've saved on all these years put together. Your income may be substantially less than your stock. Initially, when you start working, your income will be very high compared to your stock. Your flow will be high compared to your stock. Eventually, as you mature as an economy, as a business, as a human being, you will actually have a lot more stock than you have in terms of flow. And this applies to even ideas and bad jokes and, things like that. So I think this is the same in India as well. So every time a stock has gone up, it has multiplied the stock effect by the level of PE. The level of PE has been about 20 to 22. So every rupee is earning in earnings of flow has created 20 rupees or 22 rupees of stock flow in a way.
I think one other way which I remember you saying was when you create what was the word used? Tax deferred accounts or something to that effect. You also sort of create inadvertently a bit of, can I call it money? And just could you talk through that? And is that real money creation, or is that just a wealth effect or something?
This is actually a great point, because the wealth effect is something that's less understood from a this thing perspective. Now, we've seen about these things are real. I mean, most of these things are real in the sense that, listen, it's like saying if Bill Gates sold all his Microsoft stock, he would be worth $400 billion. If he said that he's selling Microsoft stock today, that stock will be worth 1/4 of what it is in the market, and therefore he would not be 400, he'd be worth $100 billion at the end of it, which is why it is ephemeral, in the sense of it is dil ke behlane ko ye khayal acha hai wala situation, because at scale you can't sell everything. The way that this works is that the wealth effect is what I perceive as my ownership. Now, if I told you, Shrey, here's ₹1,00,000 in income per month, but you have to pay 30% tax on it. You say, okay, Deepak, I'm getting 70,000 rupees a month. But I spend only 35,000 rupees a month, so I'm going to save 35,000 rupees, right? So I can save 35,000 rupees. I save this money in a year. So in 10 months, I have 3,50,000 rupees. Great. But what if I told you, Shrey, here's what, your 1,00,000 rupees, don't pay full tax on it. Instead, you can put out a certain amount of money every month. And whatever you put away as a saving, I will not tax it today. But whenever you take it out, I'll tax it. So remember, in the first approach, you ended up having 35,000 rupees a month as excess saving, right? And that 35,000 rupees a month, now you're thinking, listen, if I'm only spending 35, I probably need an income of 50. I'll pay 30% on that 50. And I'll spend my 35,000. So instead of taking 1,00,000 rupees as my income, I'll say I'll invest pre-tax 50,000 rupees, right? And pre-tax, I'll invest that 50,000 rupees. In 10 months, I have 5,00,000 rupees. I have more money in my head. I'm thinking, dude, I have 5,00,000 rupees in my PF account, my 401k, whatever, 500,000. This 500,000 sounds like a great number to you, but even you know that if I actually got the money out, it would be only 3,50,000, because I'll have to pay full tax on it when the minute I get it out. So this wealth effect is what people think they have, not accounting for the fact that you have tax on it. I'll give you an example of mutual funds. People buy mutual funds, they hold it for 10 years, and then they say, well, you know what, I have 25,00,000 rupees in this mutual fund. If you sold it today, brother, you would pay 2,00,000 rupees of tax. So it's actually 23 lakhs because of the gains that you've had in all these years. You don't think of it like that. You think that you have 25. And over a large enough period of time, the value of what you think you have, you will never adjust for taxation. This is the wealth effect. When people feel they have more money, they spend more. That's why people, like the value of their houses to go up. They're not selling their house. And not everybody is selling his house. But even if they aren't selling their house, they just feel better. They feel wealthier. And that wealth effect comes from things that people perceive as assets. So stocks, bonds,
houses,
but not cars. So if somebody told me the value of my car went up because of, by virtue of having it, I'd be almost surprised. But I won't necessarily think of myself as richer because I have it, unless it's some antique piece or something like that. I didn't invest in a car. I didn't buy a car to invest in it. I bought a car to enjoy it, to drive, take me from place A to place B. If I don't lose money in it, that would make me really happy. But the fact that I don't expect it to go up. So there's no wealth effect in cars. That's why governments promote housing, not cars. Because they tax cars like crazy, but they want to promote housing, because when people feel wealthier, they feel nicer. They want to participate in a community. They will vote. They will go and create goodwill among their neighbors. They will fix things which otherwise the government would have to fix. This ownership and wealth effect is well documented. I think the idea is, if you allow this pre-tax money to sit into retirement accounts, which are eventually taxed at exit, this wealth effect that it creates is like creating money, but that's not real money at a personal level. This is a problem honestly, it's a problem for people like us. I'll tell you. Honestly, people come and ask us all the time as a PMS, if I buy your PMS, you should pay tax every year. I mean, I should pay tax every year because you might buy and sell something and therefore you'll pay tax. But if I buy a mutual fund, I won't pay tax on it. I'll be like, no, but you'll pay tax on it whenever you actually sell. So the returns that you're getting, if you offset tax off of it, and this applies to now AIFs as well, I would say the AIF has actually paid tax because AIF is a separate entity. It would have actually paid tax. If it makes you a 10% return, you should be comparing it with 11%. Effectively make it 11% return when you compare it to a mutual fund, but you won't do it. So it's a little bit of a disadvantage to us in the fund management world because we hold a relatively inferior instrument compared to, say, a mutual fund or anything like that. But such is life. I mean, I'm not going to complain too much about that.
In the end, it seems to be a lot about optics and the wealth effect, as you pointed out. I'm just trying to draw this to the close, in my opinion. So, are we in a sense saying that the central bank isn't really the one that creates inflation? And to sort of counter your nuclear dome argument, when the government directly mails out checks to everyone, is that like a way of getting through the breaking the nuclear dome? So these are 2 points.
Absolutely. So if you give money to people, they will create inflation. Because they have that money that's available to spend. Remember, when the Fed printed money, it only gave money to the banks. The banks didn't lend out that money. So people didn't get money in their hands and they weren't able to spend. Who got the money? Relatively rich people. The stock market got the money. And, the idea was that, you'd inflate assets rather than inflate spending. When the government in the US government did this, $1,000 a month or something like that per person, essentially those people got free money. They didn't have to return it, ever. It was not lending. It was just, here's the money, please go spend it. So when they spend that money, guess what happens? The prices of everything goes up. So what was a $5, I think $7 kind of burger at McDonald's for more than 15 years has suddenly become $14. Simply because there are more people. Now people are saying the wages have gone, the prices have gone up, you should increase the minimum wage. Guess what that does? If you increase the minimum wage, more money is still available in the hands of people. McDonald's says we will raise prices, inflation goes up. If anything comes in the hands of people, and this is the worst part of things because it's not moral, I'm not taking a moral stand on this, but I'm just saying that if people get money to spend, inflation will be caused. People earn their money in different ways. That will be selective spending, that doesn't create as much inflation. But if the government prints money to directly give, and any welfare scheme, any subsidy scheme, that's what the problem is with these subsidy schemes, is it creates unnecessary inflation. If you give people money to do nothing, like in India we do the Narega thing, people do something, but it's not really, it's not huge. But what happens is they are guaranteed wages of say 100 rupees a day or 200 rupees a day or something like that. So if they're happy to live with that, that's what they'll do. They'll never become more productive than that, right? So if you give them free food, you give them a free employment, tomorrow they'll be free, liquor and something else and all that stuff. So all that free stuff just creates moral complications. But I would say it's better that inflation at some layer is tackled on by the government spending less on direct subsidies and stuff that is not productive. So roads are productive stuff, because you build a road, there'll be hundreds of businesses that will be created on top of that road, from both the destination, midpoints, shops in the middle and so on, rather than giving people money free and not having roads in the first place. So you want to create infrastructural elements instead of this thing. But you do have, I think money is created in larger economies largely moving up the value chain. And I say this by saying that you can earn a certain amount of money at the base by getting free food, right? But at some level, if as companies or economies grow up, they go from earning money by selling iron ore to, as you get more developed, you say, let me smelt that iron ore, make iron and steel myself, and I'll sell the steel instead. Then you go one level further and say, why should I sell the steel? I can make cars. I'll go one level further and sell the cars. Taiwan makes all of Apple products. Taiwan Semiconductor probably makes a lot better the chips in the market. But Apple makes all the profits. More than 50% profits in the world cell phone industry are probably with Apple. And that is because Apple's at the highest end of the value chain. It owns the brand. The Taiwan Semiconductor company could make any phone that even looks exactly like an Apple, and they will still not have Apple's product margins. And we've seen this in even Foxconn in China does not have the same profit margins as the US as Apple does. Nike manufactures shoes. It's doesn't make the shoes by itself. It just takes shoes from, say, a guy in Ludhiana and puts a Nike logo on it and then sells it for 5,000 rupees per pair. The Ludhiana guy is still selling it at 200 rupees per pair. He does not have that, So the higher your ability to build, value into whatever you're doing, the higher the wealth that you'll make for yourself. Now, I'm saying creating money for the economy, creating money for this thing is the banking system's problem, is the RBI problem. But when you're trying to create money for yourself, because in the end, that's what we want to do, is like, all fine, thank you for RBI, but I want more money for me. That money for me comes by me increasing value in myself. Either I create a company whose share price gets that 20x leverage, right, and then list it in the stock market, or I invest in myself. Instead of me saying, listen, I'll invest in some share and it'll go up by 40%, I would say invest in yourself and you'll get a 20x or 30x leverage, which is not 100% or 200%, it's 2000%. It's a substantially higher leveraging aspect. And I would say, because we've been talking about abstract businesses and all that stuff, it's building value in yourself that actually gives you the highest amount of leverage. Everything else is inferior. We end up managing money for people who have done so well for themselves. We almost always tell them, sir, we'll be the second best money manager you've ever met, because the first is you. Right, so that's unfortunately the truth for us, but I'm very happy that it's the truth for us, because when people create wealth like that, they create so much wealth that allows us to run a business, but also it makes them significant returns by just having built that leverage by themselves. I think that's where I'll end by saying, I think invest by yourself, the leverage is much higher.
I think that's a wonderful note to end on. Thanks, Deepak. Well, that's the episode. Thanks everyone for listening. If you have feedback or ideas for new episodes, do email us at podcast@capitalmind.in. And if you'd like to learn more about our PMS, Portfolio Management Service, do visit capitalmindwealth.com. Till next time.